Welcome back to the Credit Control series. In the previous video, we talked about financial credit. In this video, we will talk about service accounts. A service account is a non-interest-bearing account that is maintained by a bank for a cardholder. Any amount of the current balance that is due and unpaid after the relevant payment due date is transferred from the card to the service account. A service account can also be any other financial product or service that you maintain with a bank, such as a deposit account, loan account, credit card, or store value card. When you open a service account, you will need to provide your personal information, such as your address and social security number. This information is used to identify you as the account holder and to protect your account security. It is important to remember that service accounts are not just for loans and lines of credit. You can also use them to store money, make payments, and access other financial services. We can look at any banking website, where you can see the different types of service accounts that are offered. We will also talk about the history of credit scoring and how it is used to determine your creditworthiness. Service accounts, while being an essential part of one's financial portfolio, also indirectly influence the realm of credit scoring. How? Let's delve deeper. When you maintain a service account with a bank, they monitor various facets of your financial behavior. This includes your account balance, how frequently you overdraw, and if there are any return checks. These factors might seem trivial, but can send signals about your financial health and reliability. If you frequently overdraw or have multiple return checks, it may indicate financial distress or poor money management, which banks may report to credit agencies. Furthermore, certain service accounts come with credit features. For instance, some checking accounts may offer overdraft protection. While this can be a lifesaver in preventing checks from bouncing, or transactions from being declined, it's essentially a short-term loan. If you don't pay off the overdraft in a timely manner, this too can negatively impact your credit score. Additionally, the manner in which you manage your service accounts can set the stage for future financial products with the same institution. Let's say you've been with a bank for several years, maintaining a service account, and you've demonstrated impeccable financial behavior. When the time comes for you to apply for a credit card or loan with that bank, they might consider this long-standing relationship and your account management as a positive factor in their decision-making process. On the flip side, a poorly maintained service account might make the same bank hesitant to extend additional credit products to you, fearing that the habits demonstrated with the service account might carry over to other financial products. Therefore, while a service account might not directly report to credit bureaus, like a loan or credit card would, its influence is palpable in your broader financial narrative. In conclusion, while service accounts serve primary functions like storing money, facilitating transactions, or providing other banking features, they play a subtle yet significant role in shaping your creditworthiness. As one would with a credit card or loan, ensuring that each financial decision paints a positive picture of one's financial responsibility. Thus, it's imperative to manage them with the same diligence and attention. Credit scoring is a system used by lenders to assess the risk of lending money to someone. The higher your credit score, the lower the risk you are considered to be, and the more likely you are to be approved for a loan with a good interest rate. The first modern credit scoring model was created in 1958 by Bill Fair and Earl Isaac. Their model, called the Fair-Isaac score, is still the most widely used credit scoring model today. The Fair-Isaac score is based on a number of factors, including your payment history, the amount of debt you have, and the length of your credit history. Your credit score is a number between 300 and 850. A score between 680 to 700 is considered to be good, while a score between 660 to 640 is considered to be fair. If you are thinking about opening a service account or applying for a loan, it is important to understand how credit scoring works. By understanding your credit score, you can make informed decisions about your financial future. Here are some tips for improving your credit score. Pay your bills on time. This is the most significant factor in determining your credit score. Keep your debt low. Your credit utilization ratio should be below 30%. Lengthen your credit history. The longer your credit history is, the better. Avoid opening new accounts too often. This can lower your average age of accounts. Dispute any errors on your credit report. By following these tips, you can improve your credit score and get approved for loans and other financial products with better terms.